I travel quite a bit and do this presentation, so I'm going to tell you a quick story. I was presenting in Lexington, Kentucky about 3 weeks ago, and a high-ranking official of our state Democratic Party was in attendance, and at the end he came to me and he said, "Sounds like you don't much care for consumer protection." And my answer was, "Quite the contrary, my friend. Where I see the disconnect is the legislative and regulatory ideology and its practical application on the front line for a mortgage lender to be able to provide affordable housing products to our good citizens of Kentucky." So, he said, "You're running for governor?" I go, "Not yet, no." So, why I tell you that is I want to make sure that we're very clear in our presentation. We are not here advocating not taking care of the consumer. We are also not here making a political statement. We are here to deliver the news because we feel like the more informed you are, the better decisions you'll make and the better you'll be able to process these changes to continue to be successful in the business that you run. So I actually have a 16-hour seminar dedicated to what I'm about to tell you. I'm going to wrap it all up in like 9 minutes. So we're going to stay at somewhat of a 100-foot view, 1,000-foot view, if you will. So here are the major ways that this stuff that you've heard from Jeff is going to affect the borrower, your client. There are going to be higher delivery fees. I mean, ultimately, there's a cost in compliance. So if you have to do additional checks, which we're going to talk about, then it's going to cost money. And in most cases, lenders are in business to make money, so a lot of those costs will be pushed onto the consumer, either by way of higher closing costs or a higher interest rate offering. It's just a given fact. The second thing that's going to happen, which you've already experienced, are slower turn times. Now, let me give you an example. I'm not calling out any lender here at all, but here's part of the problem you've seen. So we have a major lender who has to go through the new rules. The loan originator takes the loan application. Here comes the loan. It's in underwriting. It's day 21 in underwriting. The underwriter gets it and says, "I can't underwrite this loan. The pay stub has expired. Send it back to the front." So the loan file goes back to the loan officer. The loan officer goes to the customer and says, "Sorry, customer, your pay stub expired." And you say, "It wasn't when I gave it to you. So here's my new pay stub." Well, it gets sped up a little bit. So now it's 15 days later, it goes back to the underwriter. The underwriter says, "Pay stub's good, but now the bank statement's expired." So you see a never-ending cycle of a long line. Ultimately, when you add that with the appraisal requirements and everything else that's going on, you have a slow turn time. When you add that with lower interest rates and high quantity demanded, the line gets longer. So ultimately, we have slower turn times. Higher rates, again, offering through two things. Number one, the cost of compliance, but number two, the line is so long. So the way the lenders slow the line down is they increase the interest rates, and that will prevent buyers who are refinancing or not doing a purchase from coming in because it'll give them time to clear the pipeline out. And finally, he's mentioned it, tighter credit standards. We have to do all that we can to keep the wrong borrower from getting in the house. I had an opportunity, I have a friend who used to be the former Bank of America president for wholesale lending, who's now the president of PennyMac. He's a good friend of mine. We had long discussions through the years. One of the things he said is, "Jeff, when I was in Washington, what we determined from the big banking side is it cost a lot more money to make the wrong loan and get the people out than it does to prevent the wrong person from getting in." So what you're going to see over the next few years, this was 2008, you're going to see all of our due diligence done on the front end. You know, quite frankly, we are going to make sure that when that person closes, we've done everything we can to almost predict that they will not default, okay? So I'm going to share a secret with you. This is going to be a little difficult to read from the back, but every mortgage is decided on 4 components. It's called the 4 C's of lending. So whether you're an FDIC bank, whether you're a mortgage lender, whether you're a mortgage broker, whether you're a local bank, you're going to evaluate your customer on 4 things: credit, capacity, which is your income, your ability to repay, your capital, which are your assets, your down payment, your money left over after you close, and then finally the collateral, the appraisal itself, and the title work. Those 4 things have to all hit minimum requirements in order for a successful loan to be made. So again, we could spend all day talking about those, but what I'm going to tell you are the verifications and the due diligence before a loan ever closes. These are the current front-end checks prior to a loan being allowed to close that a borrower goes through. 4506T, we confirm that the tax returns they gave us for a loan are what they actually filed with the IRS. And believe it or not, with the volume we do on average, we catch a couple fake tax returns every month. So there are still people trying to buck the system. And AVM, we do a computer assessment of the value of the property just to make sure that the appraisers is within the variance. We have a OFAC and a LexisNexis. OFAC is a government system to identify if the borrower's funds or themselves were ever involved in terrorist activities. It's part of the Patriot Act. LexisNexis is the private system that goes a little further, and it's a background check, really. It will identify everything about the borrower that maybe they're not telling us. We have the UDD, or the drive report. And this is one of my favorites because it is called the undisclosed debt detector. Sounds like something from Back to the Future. Remember, like, Marty, go get me the flux capacitor. Like, Jeff, go get me the UDD. Okay, I got it. Where is the UDD? And ultimately, we monitor the borrower's credit from the time they make their application until the note date, through the note date, to detect whether or not they've taken on any debts that they haven't told us about. So as realtors, what do you tell your people? Don't go buy the car to match the house. Don't go buy the big screen TV. Hold off, you can wait for 30 days. MERS report. This one is the Mortgage Electronic Registration System, and this is to determine whether or not the borrower has undisclosed properties. Just last week, we had a borrower who came off the loan. They tried to buy in their spouse's name, and we detected that they had just been foreclosed on 4 rental properties they didn't tell us about. So these are mistakes that would be made and make it into the system that were not detected until afterwards. Before. We have SAM, LDP, GSA. These are the government exclusionary list that includes realtors, builders, borrowers, mortgage lenders, title companies. We make sure that you're not on the no-no list, basically. The USPS address verification. You've heard of straw borrowers, you've heard of straw homes. We make sure that this is actually a physical address through the US Postal Service. And finally, my favorite, the second favorite, ACC, the authentication cross-check. This is through the credit bureaus. It will detect if a borrower is trying to say they're buying an owner-occupied residence and they actually live in another. So if they make their application with the wrong address, this will pick it up and say, ooh, lender, look at this address, because this is where they say they live. So all of these checks are done and are threats to the closing of your home loan. And they must be performed in order to satisfy the rules of the QM. We will, oh, you see that about we will find you. Don't lie. Tell the truth. Here we come. Okay, so how it affects what you can do. Number one, prepare for longer contract times. Be realistic in what you write. The 14-day closing is not realistic. Don't get yourself in having to ask for extensions or put pressure on the lender. There's a lot at stake. It isn't going to happen. It's going to lead to frustration. Whether you have a successful deal or not is based off expectations, what you set up front, and whether you deliver. If you tell them 14 days and it's 60, could have been a great deal, but you ruined it. And we all want referrals. You want the borrower leaving going, it happened exactly the way they told me. Accurately write your contracts. Write in closing costs and prepaids. Be as specific as possible. Counsel your buyers and sellers, and finally, do it right. If a loan is obtained with wrong information, then it will basically lead to potential money laundering charges. Those are the new charges as of August of 2012. So I'm now finished. What you learned today was the Dodd-Frank Act and how it affects you, who the CFPB is and their task, and finally how it affects your borrowers and yourselves as realtors. So I want to thank you. Thank the board. We appreciate your time. We'll stay around afterwards, answer any questions. And again, thank you very much. Appreciate it.